Well, hello, good morning, everyone. Welcome back to Accounting 204. We're going to be a shortened class today. I'm just going to look at one more problem from Chapter 8. And I know hopefully you've done the assignment by now, but this will help you for the exam. And if you look at the practice exam, you'll see a similar question to this. So you can expect to see something similar next week, next Thursday, on your second term exam. All right. Okay, so we'll next week on Tuesday we'll have a look at the practice exam, at least review the problems. There's only 3 problems, one for each chapter, and your exam will be the same as that. The usual assortment of multiple choice and 12 to 15 questions. All right, and again, that's chapters uh, 6, 7, and 8, and then your quiz today is chapters 6 and 7. Right? So process costing and ABC. All right, well, before we look at our problem, is there any questions this morning before we get started? Okay, well, let's look at our problem here. We're going to look at problem 8-12 on page 319. So I'll bring that up here. Okay, so we have Durton Company. Company reported absorption costing, operating income is shown below. Sorry, 8-12, I said, didn't I? I say that one doesn't look familiar. Um, so 8-12, variable absorption costing. So we have Coverall Inc. I think we're on the right one now. Produces and sells a unique type of case for standard size tablet computers and all those good things, waterproof. The company just opened a new plant to manufacture these cases, and the following cost and revenue data has been provided for the first month of the plant's operation in the form of a worksheet. All right, so we look at our inventory here. Okay, this is all in dollars. And as you'd expect, if they just started out first month of operation, well, they didn't have any, well, I guess they could have built up inventory, but the first month of operation implies that, well, they haven't made anything yet. It's produced, units sold, selling price per unit. I guess I'm not sure that beginning inventory is units or dollars, but I guess it doesn't matter. It's still zero. Units produced, units sold. Okay, so they produced 20,000 units. They sold 15, so that means they have 5,000 left. Selling and admin, variable costs. And again, selling and admin is always based on the units sold, so $6 per unit sold. And the fixed total, 475,000. Okay. Manufacturing costs, direct material, 12, direct labor, 9, and variable, 5, and then fixed manufacturing overhead, $600,000. Okay. All right, let's look at the first. We have 3 requirements here. First one, assume the company uses absorption costing, determine the unit product cost, and prepare an income statement for the month. Okay, so let's have a look at that. I think it was 317. Okay. Or sorry, 319 looks like. Okay, so the first requirement, well, we want to know the um, unit product cost with absorption costing, and then do an income statement. Okay, let's look at that. Can't spell this morning. So we have direct material, direct labor, variable overhead, and fixed overhead. Okay, because of course absorption includes the fixed manufacturing overhead. So we've got 8, 10, 2, and they actually figured it out for us, so that was nice of them. I don't know, the wrong question. They weren't that nice. 12, 9, and 5 are first three. And 5, I think. And we have to figure out what the fixed is per unit, right? So it's a total of 600,000. Okay, and what do we divide this by to get our per unit amount? Do we want to use sales or production? Well, it's production, so we want to divide by 20,000, right? So it's per unit of production, so divide by 20,000. Okay. And we do that, and we get $30. Okay, so our total absorption cost per unit, we add up these four amounts, the 12, 9, 5, 30, and we should get $56. All right, so we got 56. That's our absorption cost per unit. Okay. Now let's do the income statement. So um, again, it's Coverall Inc. And income statement. And I'll just put in brackets absorption, which would be the typical income statement that you do in financial accounting. That's absorption costing. Okay, so normally you wouldn't just put absorption there, but just so we can keep things straight here, we know which one is which. And don't know that it gives us much in terms of a date. Anyway, so selling price per unit $80, so we need that. And we sold 15,000 units. So we have, as our period ended, some period we don't know, 1 month period, they just started. Okay. Okay, so sales 15,000 units, and selling price is $80 per unit. And that should give us sales of 1.2 million. Okay. We'll get our cost of goods sold. Well, we want beginning inventory, which is 0. Cost of goods manufactured. And we produced 20,000 units. And we figured out our price up here was $56, or sorry, cost, full cost of production. And so we have 1,120,000. And that's our goods available for sale. $1 million. Oops. Got too many ones in there. And deduct your ending inventory from that to get your cost of goods sold. Okay, so we produced 20, we sold 15, so we've got 5,000 units at $56. 280,000. And so we get a cost of goods sold. 1,120,000 minus the 280, and we get 840,000. Okay, so just got our sales up here, our cost of goods sold here, and our gross margin is our difference. So remember, just again, our standard financial accounting, sales minus cost of goods sold, gross margin, and we get 360. Okay. All right, next we have selling and admin down here. And what does it tell us there? It told us variable cost per unit sold. So anything with selling in admin, it's always based on units sold, $6, and then fixed in total $475. Okay. So I'm going to take units sold times the $6 given and add the fixed to that, the 425, or sorry, 475, is it? Yeah, 475. Okay, so take 15,000 times 6, and I think it's 90, but okay, and so 90,000 and 475 for 565. All right, and we see what we have a operating loss, right? We operating loss of $205,000. Okay, so maybe they anticipate sales to increase, or and maybe they had a lot of initial selling and admin costs to get started, and then things are going to level off or go down from there, hopefully. Either one of those or both. They're not unusual to lose money when you first start up, but I guess you'd expect that to change, hopefully, as time goes by. So that's our first part of our problem. So we've got our income statement. We've determined our cost, our product cost using absorption costing. Okay, let's look at number 2. So now we're going to switch gears. We're going to do variable costing, and we're going to prepare a contribution format income statement, aka variable costing. Okay. So we've got a lot of this already. So our variable costing. So direct material, direct labor, and variable overhead for manufacturing, that is. And you'll note no fixed overhead here, right? So we have the 12, the 9, and the 5. That's all we have here for our unit cost. And we have $26. All right, now we're ready to do our income statement. Cover all where they just cover all ink. And we have an income statement. Contribution format. Also known as the variable costing format. All right, so sales don't change. Sales are the sales, 15,000 times 80. Okay, so our sales are still 1.2 million. Get some period here. All right, and then we have variable expenses. And variable cost of goods sold is the first one. Okay, so we have beginning inventory. Well, that's 0. We have cost of goods manufactured. All right, so we manufactured 20,000 units, and our absorption cost is the $26. $520,000. Okay, deduct ending inventory. I guess you could do goods available, so let's do that just to keep our formats consistent and do on an exam. I mean, you have some formatting there, but if you skip this step, I don't think it would be a deal breaker. You wouldn't lose any marks for not showing goods available. Deduct your ending inventory. Okay. And so we sold 15,000 units. We have 5,000 in inventory. $26, 130,000. And we have our variable cost of goods sold. Okay, so our difference here, you don't really need the brackets, but if you want, you can, 390,000. Let's put that over here. Okay, so we're not done yet though, because remember we want all the variables, so we want the variable selling and admin in here to get our contribution, right? So don't forget that. Okay. And that was $6 per unit, so that changed. Right, that was the $6 up here per unit sold, and we sold 15,000 times $6, 90,000. Total variable costs. So the 390 and the 90, so 480. Okay, and if we subtract sales from total variable costs, we have our contribution margin. Okay. So the 1,000,002 and the 480, if we subtract those, I think we get a contribution margin of $720,000. All right. All right, everybody's doing okay. Again, I think if you can do this problem and the practice exam problem, then I think you're in good shape for Chapter 8. I mean, there's some terminology and things that you should know for multiple choice, but in terms of the problem, I think you'll be all set if you can work through this problem, understand everything you're doing here. Expenses next. And remember, with variable cost or contribution margin format, it's the total manufacturing overhead that's fixed, so fixed manufacturing. Okay, so in total, it was the full 600,000, so that all gets expensed in the current period when we're working with variable costing or contribution format. Okay, and then we have fixed selling. And we have 475. And a total of that, 1,075,000. And we have, again, an operating loss of 355. So the 720 minus the 1075, we have 355,000, and it's a loss. Okay. So how does that compare with what we did up here? We had 205 of a loss. Now we're up to 355. Okay, so how do we explain that difference? And I think that's the next question. But explain the reason for the difference in the ending inventory balances under the two costing methods and the impact on operating income. Okay. Well, I guess we know what the ending inventory is under each method. So if we under variable costing, there's our ending inventory, 130,000, and then up here, 280,000, right? So those are our differences there, and so the 280 and the 130, so that's a difference of 150,000. Okay. And what that's explained by the fact that we have fixed costs in the product cost under absorption costing, whereas variable we don't. So let's look at this. So we have operating loss under variable or contribution. So we have the 355 loss under absorption. We have 205, right? And our difference, just our change here, is 150,000. So we have a 150,000 greater loss under variable costing. And then how do we explain this difference? Well, we look at our ending inventory. We have 5,000 units. And we need the variable cost, the fixed cost per unit, the $30. The fixed overhead cost per unit, the $30 is what we need here. And we get that 150. So that explains our difference here. So that's our reconciliation of the absorption and the variable costing income statements. Okay. All right. So that's I think all we're going to do for today. So I'll let you get to your quiz if you haven't. And if there's any questions before we go today. Okay, so like I say, go ahead and do your quiz today, and next week, Tuesday, we'll talk about the exam the following Thursday next week, term exam 2, and then we'll talk about, we'll probably start a little bit into chapter 9 on budgeting just to get us started on that. All right, so I'll stick around here if there's any questions for a few minutes. I'll stop the recording, but I'll stick around here. Have a good rest of the day, a good weekend. Good luck on your quiz, and we'll talk to you next week. All right. Bye for now.